Episode 560, Trading Justice Podcast. Coming at you, Matt, Mark. Dolphins play for the AFC East Championship tonight, which means we're doing this in the morning on a Sunday. We always try to do our podcast before the futures open, but enough time where we've had enough time to digest the week that was. And Matt, the week that was a lot of headlines out there. Worst start in X, insert X market or X area of the market or X total market, including bonds, since insert year here. Those were a lot of the headlines I saw on Friday and over the weekend. But, context matters. We'll talk about that. But how are you doing, Matt?
Doing good. Excited to be here.
Are you having the worst start to a year since 1998?
No, I am not, and nor do I think the market is really having that when you actually look at the context of how the market has been performing over the last couple months. But in general, doing good. Excited to be here for another edition of the Trading Justice Podcast, and excited for the Dolphins later on tonight as well. Not every day or every year the Dolphins get a fight for a nice little AFC championship, and the Bills, they scare me about as much as any team in the NFL does, but we'll see what the Dolphins can do later on tonight.
Well, Matt, it was a rough start in certain areas of the market of the year, particularly tech. Stocks like Apple, a really just terrible week for Apple, who didn't seem to get any breaks on downgrades. And Apple, and you pointed this out, I don't know, maybe 10 times over the course of the last 10 years. When Apple gets a little bit of volatility, it tends to make other things wobbly as well. You point out, just you were all over this in August. When Apple first started getting wobbly, you're like, okay, well, probably going to have some wobbleness in other areas of the market too. Talk about the week that was, in tech specifically, then we'll get into other areas of the market.
Yeah, and again, rough start for the year for most of the market, but specifically here within the technology space. When you're thinking about technology and the downward movement in price that we had to start the year, I think number one, context matters. The trend going into the start of the year matters. Being extremely overextended from a pure technical perspective, off a 20% rally in the S&P 500 over the last 2 months of the year. I think that matters coming into the first of the year. I actually see the downward pressure in price in the market not necessarily as a negative thing to start the year. I think it was extremely important to alleviate the overextended pressure that has been putting on the market for quite a while now. I mean, it's been a while since we've had RSI on technology underneath 50, and that's kind of where we have right now after this move at the first of the year. And it was really started with Apple, kind of day one here. You get a downgrade on Apple, citing weakness out of China, specifically on iPhone 15 sales, which gave a little bit of concern for the growth part of the conversation when it comes to technology, consumer discretionary, the growth areas for the market. But again, I think any news story that came out that gave a little bit of concern for the growth areas of the market was going to be that news story that the market said, okay, time to lock in some profit, And it just so happened to be Apple. And you mentioned August and what happened in August. That was an earnings report out of Apple. And Apple's the number one company in the marketplace. It's the number one market cap company in the market. It represents so much to different themes in the market, from the strength or weakness of the consumer to the consumer discretionary space itself, to what it means to technology, to what it means from international to domestic. I mean, it represents so much. And so it's hard oftentimes for the market to move in one direction when the leadership of the market is going to move in the alternative direction. And so Apple gets some downgrades to start the week. And then you had a little bit of piling on with downgrades throughout the week. I think they got 3 total downgrades throughout the week. So the first one kind of set the stage. You saw a big gap down in price, and then it just kind of faded down. And what's interesting to me is, again, I do not see this necessarily as a tremendous negative for the marketplace. I see this as one of alleviating the ridiculously overextended pressure that was against the market, specifically in those growth areas of the market. And regarding Apple itself, I put Apple on the Tackle 25. It replaced Microsoft when we released that list last week. Mark, if you're going to tell me we were going to get 5% downward pressure in price to start the year on Apple, would I have made the same decision? 100% of the time, I would make the same decision. I don't think this changes the fundamental backdrop of Apple. I don't think it changes the forward-looking guidance of Apple. What I do think it changes is the technical perspective of Apple, which was one of a pretty decent trend, little bit of chop. And now we're talking about Apple at the 200-day moving average, which is typically a really good buying zone for a company like Apple with the fundamental backing of a company like Apple. So, from a valuation perspective, you got some concern on Apple a little bit. PE ratio in the low 30s, forward PE ratio around 27. That's a little bit of a concern. But the downgrade itself, I just felt was alleviating more pressure than anything. I'm not taking it as necessarily as a big negative for the market. As of right now, you have concern, but at the end of the day, we always have a little bit of concern. I think the alleviating the pressure that the overextended nature was putting on the market, I think that's a little bit more important than the downgrade that Apple got this week.
Yeah, I know. I mean, and alleviating that pressure, you and I have been around long enough to know that when you get the RSI hanging up there, it's really tough to take that next leg up to regroup.
Yeah.
And it's tough to find a lot of good trades that you love, to be honest, just from a practical standpoint on the bullish side. That certainly has alleviated itself.
Well,
But Matt,
technology went from RSI 71 down to 30 in a week. And so,
yeah, so
yes.
we're not going to be talking about that for a minute, right? That for a minute.
Hasn't that been like one of the number one conversations over the course of the last month in the market? Not just the last week or two, but the last month has been a little bit of Keith King in my ear, plug your nose and buy, given the fact that the market had such ridiculously overextended situations. I mean, RSI was living above 90 in many areas of the market for over a month straight. I think that's important. I think getting back to a little bit more of a normal market where the market just does not go up, 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 leaving a lot of people behind. I think the retracement, the pullback, however you want to categorize it, I think that is important to get that out. And I think it's also important as we go into earnings season, Mark, to alleviate a little bit of this pressure. One of the things that I think is extremely important as you navigate earnings season is understanding of the perspective we have going into earnings season. If a stock is at the high price for the quarter, breaking out of everything, overextended against everything, man, those expectations are so lofty that it is damn near impossible for the market to beat those type of expectations.
We talk about this all the time. We call it top of the chart type problems. That's we talk. Whenever you hear us say top of the chart problems, that's what we're referring to.
Well, and I think if you're looking to catch a theme, to catch a trend, to catch a leg, however you want to categorize it throughout earnings season, I think starting earnings season at a little bit of a low point near support is going to be a little bit easier to develop all of those things that the bulls love to see coming throughout earnings season. So again, nobody ever wants to, sit through a pullback in the marketplace when you're bullish or slightly bullish. But I also think these things are extremely needed to get some stabilization back into the market from a pattern and a trending perspective. So I don't see the start of the year as negative, even though all the stats from a seasonality perspective. Santa Claus didn't come to town. The second day of the trading year, that ended down for the 5 days before the end of the year and the 2 trading days at the start of the year. So Santa Claus technically didn't come to town. And then when you're talking about the January barometer, kind of that first week of January ended down. That's typically a little bit of negative for the market moving into the future. And so, yeah, seasonality would suggest that the year starting down, the market starting down, Santa Claus not coming to town, even though like I think that's a foolish argument. Santa Claus was all over the place from November to December, but at the end of the day, seasonality, it's an indicator. I think context matters when you're looking at these type of macro indicators, and the context is you're starting the year off down, but that's after a 20% parabolic movement in the market over a 2-month stretch that had everything completely overextended. I think this pullback is absolutely needed.
Yeah, no, I mean, and one of the things I sensed, Matt, in looking at charts, it was very growth. The pain was heavy in growth, whether it was, mega cap or, things like ARC looked like, they started the year off with a bomb going off on their chart, just lots of volatility. But man, I didn't see that volatility all over the board. I saw a lot of areas of the market. I mean, defensive stocks active as if somehow on January 1st, recession started and we are going to have clean, crisp rotation in them. It was not a fearful week, to say the least, in the market. It was a growth-oriented selling week with other charts setting up a lot nicer. What did you see in the other sectors?
Yeah, I kind of look at it the same way you do, Mark, when you're looking at this from is the pullback one of those sell everything moments, or is there rotation happening? Is there just profit taking at the top? What's going on? Understanding the context of these pullbacks, I do think is important. Hey, and I'm with you right there on it, Mark. I don't think this is an all sell everything moment. When you look at the larger landscape on the heat map, and you look at all of last week, Mark, on the heat map, what you're going to see is you're going to have a little bit of green spots, a little bit of red spots in general across the RSP landscape, the broad market landscape, where the big selling pressure was really kind of on the aggressive side of the equation, very, very technology based, consumer cyclical based, not even necessarily communications. It did start the year down, but it wasn't an all sell everything. The only areas of the market that we really saw that sell everything was technology and a little bit of consumer discretionary, but that was not across the board. Maybe a little bit of real estate as well, but it really wasn't across the board. Healthcare up on the week, energy up on the week, consumer defensive up on the week, financial up on the week, utilities up on the week.
Yeah, that's hardly a sell everything panic start
Half
to
the
the year.
market is up. Half the
Yeah,
market is up, half the market is down. But the market that is down is Mag 7, is aggressive, is technology. And so when you're looking at the S&P and it's weighted towards those areas, obviously you're going to see a little bit more of that volatility than what the actual broad market kind of represents there. And so again, when I'm looking at it from a sector perspective, I see a lot of pressure in technology. Obviously, that's where Apple was. That's kind of what led the downward pressure in price this week. You obviously have Tesla, Amazon down fairly big as well. Semiconductors down big as well. When you look at our rankings at Tackle Trading, Mark, we rank these sectors every single week in the Tackle Trading newsletter. And we did get some downgrades in the market. We downgraded the S&P for the first time in the last 2.5 months. You downgraded technology 10 points, a fairly large downgrade for us. It went from the highest rated sector down to around that positive 30 level. And again, I think that was important to respect the volatility within technology and the storyline that's playing out with Apple. I kind of like Apple at the 200-day, but liking something around a moving average is very different than, okay, now it's ready to giddy up and go time. And so you got a fairly sizable downgrade in technology, you got a downgrade in discretionary, but communications did not get downgraded from us. In fact, communications and finance are now two of the highest rated sectors at Tackle Trading. And they both set out, I think going into earnings season, finance is set up pretty decently from a macro perspective. I think communications is set up pretty decent from a macro perspective going into earnings season. I think energy is set up pretty decent from a macro perspective going into earnings season. And I think healthcare is set up pretty decent going from a macro perspective going into earnings season. And so you didn't see an all sell everything last week. You saw a sell aggressive growth, aggressive asset classes. And it was kind of one of those situations, Mark, where it was almost like nobody wanted to sell coming into that last week, whether it was for tax reasons or other reasons. But then everything kind of came into that first couple trading days of the year. And so I do think the downgrades in technology, discretionary, real estate to a certain extent, all three of those areas of the market had some negative weeks this week. I do think those are the areas that are a little bit more concerning right now. As for the cyclical areas, finance, energy, basic materials, industrial, not a lot of changes there. Basic materials and industrials getting a little bit of downward pressure in price to start the year. But again, that's more of a resistance over extended conversation. I wouldn't say massive volatility. The only area of the market where we've seen really big increases in volatility are ARC-like relatable asset classes, very ultra growth type oriented, or the areas that are really tied to technology, Apple, semiconductors. Those had a rough start to the year. But over more than anything, I just see this as a little bit of a downward pressure on price that's alleviating the overextended situation. I think we're going into earnings season on a little bit of a better note, quite frankly, with the pullback than we otherwise would have been going into earnings season if we were talking about an overextended environment. The one thing I cannot stand about going into earnings season is if you're going into earnings season with an overextended environment, oftentimes you're going to see a little bit of additional volatility in those earnings season. I think alleviating that pressure gives us a little bit of fresh eyes going into earnings season.
Yeah, I think, listen, if you are not driven, this is how I view markets. If you are not driven by a theme, like 2022, you were driven by a theme. Fed raising interest rates higher for longer. That put longer term downtrends in place. There's no theme out there on the negative side, Matt, which means
there's concern. Like there's concern everywhere, but in terms of themes, there's not a themes are united. There's a lot of opinions on the market. There's a lot of concern on the market. We could talk about the bear case versus the bull case, but at the end of the day, there's no united theme that the market is working against right now on either the bull side or the bear side. But that's also what earnings season kind of establishes as well.
Yeah, you're going to have to see inflation this week, like surprise to the upside for it's just too early to be a bear. Like, I think bears will have their moment. It is tough to break an uptrend. It doesn't happen overnight very often. And Matt, as we get into the year and earnings season's coming up, and we're going to talk a little bit about earnings here in a minute. We're starting to get economic data come in. We had Friday's unemployment report, in my opinion, mixed, right? If I was, how in debate they used to say you're going to take one side or the other, and you had to pick that. You had to debate that side, right? Mm-hmm. Like if you told me to say why that unemployment report was good or why it was bad, I could make a case. I think I could get up there on stand and say this is why it was good, or this is why it was bad.
Around the labor market numbers, and when there's a lot of context, there's a lot of perspective, and there's a lot of opinions. And I do think, you were a debate champ back in the day. Back in law school, I was taught the same thing, right? You want to come into a situation understanding both sides of the ledger, both sides of the argument, both sides of the conversation. And with labor market numbers last week, you had a little bit of good, a little bit of bad. And depending on your perspective in the context, I think you could paint that a really significant argument one way or the other on the labor market numbers. The market's always going to take whatever the reported headline numbers are, though, Mark. The context is important for us understanding kind of those landmines down the road a little.
Down the road, yes.
Those themes that might emerge down the road. For example, one of the strengths of this market for the last year has been the labor market. Would you agree with that?
Back in February, when the unemployment report came in insanely strong, recognizing how strong it was made me money, because it was like, okay, whatever bearish things I had on cyclical, we need to take those
Put a
off.
floor in the market.
Yeah, if you think bonds are going to just drop from here, if you think yields, that's not going to I mean, unemployment 2023, the number one story was Mag 7 AI. That was the number one story in 2023. The strength of the labor market, the resiliency, has to be up there in the top 5, though.
In the face of increasing interest rates, in the face of every projection that was opposite of that, yeah, it was a fascinating story. But couldn't you also kind of paint the argument that 10 out of the last 11 unemployment reports have been downgraded?
Oh, they ain't as strong as they make them out to be.
I guess that's my point a little bit.
But no, I mean, come on, let's be honest with what's going on, right? The headline number is fluffed up a little bit because it makes good headlines and for political purposes. And I think governments across the world have been guilty of this in some form or fashion for, I don't know, my whole life.
Decades.
Yeah, so it's not I hate Biden. No, this is a normal function of propaganda coming out of power, right?
Every president would love zero interest rate policy during their time frame as president. Everyone would.
And so yes,
would enjoy an increasing of interest rate conversation. You're right. Every degree of, I think you can argue it a lot of different ways, but I do inherently believe that our economic data is not the end all be all of truth economically. I do believe
that is a very nice way of saying it.
I do believe that
it is optimistically skewed, right? It just is.
Yes, people put the bear goggles on when it comes to the economic data. There's no doubt about that. But I do believe that it's also what drives the market is these headline numbers. Because, Mark, when you look at the labor market, for example, the labor market is the number one reason the market is held up. It's the number one reason why we didn't see that ultimate recession last year. It's probably the number one reason why we won't go into some deep contraction of a recession this year. And you and I look at the labor market at 3.7%. The market looks at it at 3.7%. You and I look at initial claims at 202,000. The market looks at initial claims at 202,000, and they say those are good numbers. That's the market. They say that's good numbers, and that's what, when that comes out, that's it. The market has accepted that as good numbers. They're going to move on to the future. The market is not deep thinking when it comes to these economic reports. They get the number, they move on. Context matters as things start to break in the market. And as things start to break in the market, then it comes back to the labor market wasn't as strong as it otherwise was from a reporting perspective. We all knew that. Everybody jumps on the bandwagon. That theme, that becomes a united theme, but it's always after the damage is already done to the market, with the market participants trying to give context to the meaning of life after volatility punches them in the face. And so for me, when I look at these economic reports, Mark, yeah, do I understand and know full well that we have Goldilocks interpretations of these economic reports? Yes, of course I do. But at the same time, I also have to take them at face value, given the fact that this is what matters to the market and not necessarily the context of the minute detail of the 10 out of the last 11 reports have been revised to the downside. I think that's important to understand. I think that's important to understand the true nature of the labor market. But at the end of the day, what matters more? The context that the labor market is not as strong as otherwise suggested in the reporting of the labor market numbers, or two, that the labor market is just stronger than anticipated.
What do you want me to say here?
Like, what's more important to you, I guess, is it the context of what underneath the surface? Because I know people want to talk about the context underneath the surface, but what's more important to you specifically to how you navigate the financial world?
I accepted because when I started digging underneath, and there was a few weeks where I'm like, this is crap. Why can't we have honest data, the market? And then I was like, oh yeah, Mark, you're a trader. Like you can and this is something that has kept me alive in the world of poker, sports betting, and now the stock market. You can wish for a world that you want, or you can adjust and adapt to the world you have. And if the employment claims are always going to come in strong, use that. That's information. That's powerful information, right? Like, yeah. So accept it.
And also, Mark, you can't manipulate this economic data to go from good to bad or bad to good.
No,
that's not how it works.
Companies aren't out there laying off hundreds of thousands of people. This
0.7% unemployment report and actually live in a terrible labor market.
No,
the manipulation is on the edges. It's
yes
level. It's not deep. And don't get me wrong, I'm with you. Every economic report is a snapshot. It's either a survey, an opinion, or projection analysis. It's based on probabilities and surveys and reports, but it's not the bastion of truth. It gives you a snapshot of the health of a specific space. Do we know exactly? Well, for example, is the real inflationary impact on the American consumer right now at 3%? I would argue no.
Of course not.
Inflation is not 3%, but
Matt, if that
3%,
the inflation report this week can come out and be an outright lie, and if it comes in soft, there are a ton of trades to be made off of that, right?
Mm-hmm.
Like, I'm not going to spend like an insane amount of time. Well, did you know that the healthcare data is manipulated here and the actual inflation? That's great, but low inflation report set the stage for
it's that stuff, yeah.
But that low inflation report we had 2 months ago set the stage for a monster rally. Like, so you can like go in and try to be an academic, or you can be a trader, and you can be a gamer, and you can make some money, right? And so what are the themes that emerge? And if you have a low uninflationary report with a unemployment report on its surface that is decent, that sets the stage for Goldilocks type headlines. Try shorting that.
Mm-hmm.
Try shorting that, because it's not going to work out very well for you this week.
Well, we don't need to stay on this conversation too long, but I'll just suggest this. When you're looking at the labor market numbers, are they accurate? Are they inaccurate? I'd say they're a snapshot of accuracy. The most inaccurate report, in my estimation, is the CPI report.
Well, you've been on that for 12, 15 years.
Oh yeah. I was born with that opinion.
Yeah, like I started hearing about that before I cared about the CPI report.
I think it's by far the most inaccurate report.
Yeah, honestly, Matt, you have been on that for over a decade.
And I never will not be on that, because it is the most inaccurate report in the market regarding tracking what real inflation is versus what the stated headline inflation is. Of course, I think it's the most inaccurate report, but it's also, I'll tell you what, it's also the most important report this week. And if inflation bumps up, it will change my opinion towards the central bank the same way it will change other people's opinion towards the central bank. And I'm not going to spend a second on CPI day on Thursday thinking, yeah, but what is the real impact on people in general with inflation? What is the real inflationary report? I'll have that thought later on that night. But when it comes to assessing the market, what the market is doing, what sectors are going to move, what areas, what is the dollar going to do in comparison to gold, it's not that. It's baked into the conversation that these reports are a snapshot of an environment, not the bastion of truth of that environment.
Yeah, no, I think, and I think these are important hurdles to eventually overcome. If now, some people don't even care
You
about
have to
macro.
overcome them as new traders. You
You
have
have to, though, or else your biases will cost you money. They
that.
just
They
will.
just
Matt, while equities were doing whatever they wanted to do, crude oil is holding its range. Natural gas actually was one of the best assets in the entire market to start the year. So gotta love natural gas. It's fun.
you natural gas guys. You get like 3 days a year.
I know. Listen, we get it. We gotta enjoy it while I had it. Like, listen, but
I just laugh all the time.
yeah, well, I might joke
Talking about
about natural gas. I am not joking, man. I have been on this a month. I called the freaking bottom on this to
I,
this point. I think there is a case to be made. And Matt
Frank,
is looking.
I think Frank called it his wild card pick in the prediction podcast.
It
Was
was such a good pick. It was such a good pick. But
I love the bottom up analysis on it. It's great. It's fantastic. It's still natty gas. It's
I
just
don't know what the weather's going to be, so I don't know have anything else intelligent to say other than just having fun with it. But I do got a few things to say on crude oil.
yeah.
On crude oil, I've been making the case on crude oil for a while. The case is now a technical one and not just a speculative macro big theory one, right? And while I thought that might play out that way, it's so nice to see. And Matt, it is doing. If you wanted to be patient, boy, it has done everything you possibly could want it to do over the last month, hasn't it?
Yeah, I didn't want V shape. Basically, when you're looking for reversals, you want everything to kind of simmer down and settle down, and buy time. You basically in reversal analysis, you try to pull your best central bank impersonation, and you just try to buy time. That's it. Just the more time you can buy in reversal, the stronger the reversal is going to be. Coach Tyler, the great Coach Tyler from Tackle Trading, he used to say, the higher the base, the longer the base, the higher in space, right? I think you can say a little bit of the same thing for reversal analysis. The longer you spend in reversal, the better the reversal is going to be. And the reason that's the case is because of what happens with longer duration moving averages. The things you do not see on a daily chart, for example, the things you do not see on a daily chart are the 9 weekly, the nine monthly, the 20 weekly, the 20 monthly, the 50 weekly, the 50 monthly. You don't see those on that daily chart, but those are there. They're sharks. They're there. They're laying right there underneath the surface, waiting to pounce. And so when you buy a little bit of time in reversal analysis, and I do think it's important when you're going through the art of the reversal, is to get that time duration and component to happen, because that allows longer duration moving averages to converge either with the breakout channel or right underneath the breakout channel, so that when you do break out eventually, you have a little bit more open air type feel. And so when crude was, I think it was about 3 weeks ago, where you bought the dip, or not the dip, but basically the low point on the tick chart.
I've been running my mouth over the last month.
Yeah.
Been running my mouth.
You're prone to run your mouth, like you run your mouth.
Mm-hmm.
You enjoy running your mouth.
I'm prone to say outlandish things, throwing them against the wall and seeing if they stick.
But you've been on crude oil since the tick, and you have not budged. And even when, like, I remember there was a day, Mark, where the 9 EMA, you bought the tick, and the 9 EMA came and pounded it down. And I was like, I am not going to call that bullish in front of a 9 EMA tester. Are you kidding me? Like, that was my type of mentality. And you're like, I don't care. Me and Buffett, we're YOLO, baby. We're going on energy here. And I was like, yep, it's Mark and Buffett. But you guys are right. And the rest of us, I don't want to say the rest of us are wrong, because you're getting the analysis you want if you're looking to become a bull on crude oil. I'm not there yet, but I do like the improving condition. And you also, on crude oil, you're starting to get, I want to get your take on this, Mark, because crude oil is a technical conversation for me in reversal analysis.
Well, yeah, and that's the thing, Matt, is I don't have to make the macro case anymore, because it's now a technical one.
Yeah, it is. 1000% it is when you're in reversal. But I want to get your take on the macro, because you're starting to see a little bit more activity, I would say, out of the U.S. military in the Middle East. You're starting to see the U.S. punch back a little bit on the Houthi rebels, for example, out of Libya.
Well, you had a Hezbollah attack Israel.
Out of the north of
You
Israel.
had a terrorist attack in Iran. You have the whole freak.
We're starting to build a little bit here, bro.
No, and think of it from, and this is how, because I'm a defensive oriented trader, and I don't care if it's Apple or oil or whatever. I'm like, what's the case to send it lower? And if I can't find a case, and I talked about this in my Cash Flow Vikings trading lab this week, if I cannot make a case, like you were talking about, understand both sides of the argument, if I can't make a case to send it lower, it's probably going to test higher to see how far it can go. And who is going to short oil at this point with tensions in the Middle East?
While you're setting on the 200,
after a big, huge sell-off, after stabilization, like, come on, nobody's going to short here, which means you're going to test higher.
That's kind of how I feel too. I like, all things being relatively equal, I think you do test higher here. But you were talking about, making that bear case. The bear case on oil is increasing supply out of the U.S. Like, is that an argument you want to get on, increasing supply? Like, it's been impressive, the U.S. supply, but I don't think the U.S. is purposely trying to increase their supply. I think it's happening at the corporate level. I don't think it's happening at the government level. Saudi Arabia is not going to increase supply. They're looking to shut it down. OPEC's not increasing supply. And so you go to economic deterioration. Well, Mark, if we do get the economy to deteriorate, hasn't crude oil already been going down?
Yeah, you better get the hell out of your industrial plays and your financial plays and the stuff that rocketed over the last 3 months. Crude oil already priced in that.
Oil there, no short all
other stuff. Yeah, I mean, so and that's if you get economic deterioration, which, Matt, I'm sorry,
I also have no reports there this week for that either.
It is an election year. Not just in the United States. You have more people going to the polls this year than any year in the history of the human civilization.
Like 4.8 billion people is going to the polls?
Yeah, and so that's a lot of money that is going to be put in to prop up existing regimes, existing economies, not just here in the United States,
everywhere.
Elsewhere. You have China that is a year deeper into a full-fledged reopening. So yeah, because somebody asked this to me on the lounge, like, why would you go long oil here if with a possible recession? I'm like, keyword possible. And I think just on that argument, a lot of pain's already been maybe priced in. And what happens if we don't get one?
Yeah, what happens if you don't get the recession? The same way people have been calling recession every year since 2015. Legitimately, people have been calling a recession every year since 2015. And so what if you don't get one another year, that the economic recession analysis doesn't kick in? And Mark, whether it's manipulation or improvement or whatever your perspective is, I'm kind of with you on don't you think these governments around the world where you have a higher percentage of people going to the polls at any point than in human history, don't you think they're going to do whatever they can to stabilize their economy?
That's a tough backdrop for an economy to collapse, right?
I'll give you case in point. Case in point, labor market numbers. Out of all the areas of the market that we track in the labor market numbers, what was the number one hiring in the labor market numbers this past month?
I don't know. I don't know the answer to that.
56,000 jobs.
Okay.
Healthcare, I think 37,000 jobs. It was not close. It was government.
I should have known the answer. That was it was make context in the conversation.
But so I'm with you on that. I just think technically, I would like to see resolution in reversal analysis.
Yeah.
And that's where it becomes.
Well, and it is a technical conversation now.
It absolutely is, because what else do you need to see? What else?
Mhm.
Are you going to have a fundamental argument at the 200 weekly? No, this is a technical conversation. And the only equation that I have with crude oil is, where do you feel comfortable with saying, okay, now we're bullish? Because as of right now, I can't say you're bullish right now. I think the argument is neutrality right now.
Which is great for cash flow.
I do think 75, you close above 75. I think that's a level right now that if you close above 75, that would be an increasing resistance level. I think you can make an argument above 75. You also have a resistance level right around 78, but I'm anchoring in reversal right around 75 and a half. There's a pivot right there. 50 period daily moving averages right there as well. When you look at it on a weekly chart, you got the 90 MA right there at 75 as well. And so I think you're looking at just neutrality right now in crude oil, but you're starting off the week at 73.95. You got a 75 resistance level that if you close above that level, I think you got to call that confirmation. So yeah, crude oil's a little bit more in the spotlight coming into this week. Probably a next week conversation, I would say, not necessarily this week, but it's getting there, Mark. I've been saying
Well, ideally, it's a 3 week from now conversation.
starting to get there. Well, ideally, yes, but I just think when you start
You got to be prepared.
development, you got to get it on the radar, and I think that's what we're doing with the crude oil conversation.
Yeah, no, listen, you and I have made, going back the last 15, 16 months, some great calls on this podcast where you and I are very much more prone to make calls than on the halftime report, where we're reporting a lot of information. Like, you should listen to the podcast every week for the high conviction. We should have a segment, Matt, called high conviction type plays or something like that. But this has been one for me on crude oil. I think it's fantastic for cash flow. Yeah, and then put, like, for every $20 of crude oil, go put $1 into natural gas.
A little walk around money.
Well, Matt, listen, not a lot to talk about on gold. I'm sure we'll talk about gold more next week, kind of in a just neutrality type pattern. And just comment on the dollar, which had an interesting start to the year, and gold price action this week.
Oh man, if you want to understand why we're dealing with downward pressure in price in the stock market, we can talk about the Apple downgrade 1000%. We can talk about the Apple downgrade, that was a catalyst, but you can also talk about this deep bearish retracement that we've seen to start the year on the United States dollar. Market started the year overextended. Well, the dollar started the year overextended to the downside. So a little bit of a deeper retracement going on right now in the US dollar, and labor market numbers were extremely volatile within the currency and the commodity areas of the market, far more so than the United States stock market. We saw the volatility. That's usually that's not news at 6, Mark. More volatility in currency and commodity than US equities. That's typically the case when it comes to economic reports. But you saw a lot of price movement relative to the dollar and relative to gold. The only thing I'll suggest is the dollar's going through a deeper retracement. And while the dollar's going through a deeper retracement, you're dealing with a little bit of a pullback in gold. Gold, I got this as a cup and handle. That's kind of what I had it last week. I still have it as a cup and handle. So technically right now on the US dollar, I got the US dollar as a deeper bearish retracement. Let's see if we can get a little bit of price love here. Yeah, if you're looking at confirmation, anything underneath 102 on the dollar index would be a really good level to kind of anchor against on the dollar index. On gold here, Mark, to me, this is a stabilization playing out above 2K. This is as long as we've kind of held up above 2K. It should participate here as well, but we'll see how this cup and handle comes through in development. In a cup and handle, you got two really kind of points you look at. You look at the cup and you look at the handle. Right here, you're looking at the handle starting to get created in the market. But ultimately, what cup and handles lead to is continuation breakout analysis, and that would be 2100. And so I do think you're looking at gold, and in general, Team Tackle knows this very, very well, but in general, when you're going through stabilization or continuation analysis or neutral analysis within gold, you're going to kind of match that within GDX and the gold miners as well. I got this as a covered call environment in the short term until we start talking about a breakout analysis. But I've been impressed with gold. I know gold had a couple moments where it could have breached that 2K. It didn't. Gold's had some volatility over the last week or so, but again, I think we're looking at a 2100 resistance playing out a little bit. So cover it if you got it. The next trade on gold is a breakout analysis as of right now.
Yeah, let's talk earnings, Matt. Listen, in the halftime report this week, you mentioned, yeah, banks have earnings this coming next Friday. And I was like, oh, crap. I thought it was 2 weeks away, but it's not. Earnings season kicks off this week. And Matt, we're lacking narratives in the market right now. We're lacking themes in the market. And while that's fantastic from a cash flow perspective, it's only a matter of time before a narrative takes hold, right? If you got inflation come down again this week, and then unemployment reports decent, Goldilocks narratives will start being thrown out. But earnings season, when you come into an earnings season without clear narratives in the market, it gives a chance for earnings to become the narrative in the market. And so we wanted to do a segment heading into earnings season on earnings season. Where do you want to go with this, Matt? I know you got a lot of material prepared.
Well, I just want to talk in general about expectations and the landscape of where we're at as we come into the fourth quarter reporting season. So first and foremost, it kicks off this week, Mark. Traditionally speaking, when you talk about the start of earnings season, throughout my career, there's been basically three stocks that were looked upon as the starting point of earnings season. When I started my career back in the early 2000s, it was Alcoa. Alcoa was that company in the Dow 30 that kicked off earnings season. Once Alcoa came out, we were off to running when it comes to earnings analysis. And then there was a little bit of time, not a long time, but there was a little bit of a moment where there was a move to make Nike, one of the very early down S&P 500 components, to make Nike the official kickstart to earnings. I think at this point, almost everybody in the market recognizes JP Morgan and the Friday that the banks report as the kickstart to earnings season. And so earnings kicks off this week for the fourth quarter reporting season of 2023 with the banks this week. But it's not just the banks. You actually have 9 S&P 500 components reporting earnings this week as well. And so it kicks off this week, kicks off with the banks primarily. Now, when it comes to an earnings report, Mark, why it's important is it gives us important context to everything we talk about from a fundamental perspective regarding these companies. Apple just got a downgrade to kick off the year. Apple reports in 2.5 weeks from now. We're going to see if that downgrade was warranted or not. Right now, it's an opinion. Right now, it's a projection. Right now, it's a probability. After earnings, it becomes a certainty. And so when you're looking at earnings reports, the three components that we track that are very important to understand the health of not only an individual component, but the health of an industry, the health of a sector, the health of the entire marketplace are EPS, revenue, and forward-looking guidance. We look at EPS to show how much money they're making per share. We look at revenue to see how much revenue is coming in for the entire company. And then we look at forward guidance to see how well this company is projected to do in the future. So EPS and revenue tells us how well they performed in the past 3 months. Forward guidance tells us how well they're expected to perform in the future, both from the next quarter perspective as well as the next year as well. Now, like I said, earnings season is important for a variety of different reasons, but one of the number one reasons it's important, Mark, is something you talked about just barely, and that's the development of what we call market themes. It's important when you look at any individual component. It's the number one moment that you need to understand the companies you're investing in. But when it comes to the top-down analyst, Mark, the things that you and I love doing, looking at the market, sectors, industries, individual components, understanding how the cross currents of currency can impact commodities and thus the S&P 500 and those equity positions, you start to see market themes get developed as you start to see these growth components report earnings versus the value. So are we moving into a growth conversation, or are we moving into a value conversation? Well, oftentimes the strength of the earnings reports we're seeing out of technology, consumer discretionary, and communications in comparison to what we see out of consumer defensive, healthcare, utilities and whatnot, that can help us understand, is this more of a growth moment in time, or is this better from a value perspective? You also get into market themes from an aggressive to defensive perspective, because you have growth in every sector. You have value in every sector. Some sectors have more, some sectors have less, but you have it a little bit of everything. You have an aggressive defensive conversation as well. You start to get into the, okay, how are these companies doing? How bad is the international exposure versus how good is it out there? Is domestic sales doing good, or is it international sales doing good? Apple got downgraded because of iPhone sales. Is that iPhone sales out of China, or is that iPhone sales out of the US? Why is that important? Because if we're seeing international weakness, well, that might give us a little bit of a theme that is developing that might impact the S&P 500, which is more sensitive to international economics than, say, the Russell 2000, which is chock full of a lot of companies that primarily do business within the domestic front. And so you start to see a lot of these themes develop over time when you're talking about earnings season. Mark, when you're looking at the development of themes, there's a couple moments during earnings season that are important. The first kickoff to the banks is always going to be an important theme. Are banks dying or not? Are we going to get another Silicon Valley or not? Are the regional banks cratering, but are the big money center banks doing great? And so you're always going to get these themes from an industry to a sector perspective, but I'm talking about the development of market themes. And when you look at the development of market themes, there's a couple weeks that you really look towards. The second week of earnings has been a very big development week for themes throughout earnings season. It's because we get the banks to kick it off, and we get a lot of them on.
They set the stage.
They do. They set the stage, and then you get two really important components the second week, typically in Netflix and in Tesla. And so you get two really important growth components that kind of set that stage for the growth conversation. And then you get the Max 7 week, where you have Apple, Google, Microsoft, Amazon, where the big dogs report. And so and this is something we will go through every single day in the halftime report. Every day we'll report on earnings, all the major components. Every day we'll talk about how the impact to the landscape is. The earnings season is just something we like to get dialed in as we go through it. Mark, can you talk a little bit about the importance of understanding the development of themes throughout earnings season?
No, it is so. Themes in earnings season are twofold. One, you have the mega theme. These are the ones we're always looking for. They're rarer, right? The type of theme like you had develop in the first quarter of 2023, recognizing that, holy cow, this little thing called AI is getting mentioned everywhere. Holy cow, the price response, not only on the earnings day, but the follow through on these type of plays is really stable, really strong. And so recognizing a big, huge, massive theme can provide quarters, sometimes years worth of trades. And that's certainly how 2023 played out, Matt, is that you saw the AI theme developing, it hit, in quite the year, right? And guess what? I have a feeling it's going to provide a few more trades down the road.
I remember reporting on NVIDIA in the halftime report, Mark, and my job was just dropped. I was like, these numbers are just like, and it's I remember the first time they upgraded their guidance a year ago, Mark, and you and I were sitting in the halftime report, and I was just geeking out over this guidance report. And then the next quarter, I remember you and I were debating throughout that quarter the AI, and to the point where we were saying you can't just talk about AI any longer. You have to actually see it in your earnings report. And then all of a sudden, NVIDIA
And then all of a sudden
had like a triple beat, just hit an absolute home run. And it wasn't just based on projection analysis or, hey, what we're going to hypothetically do in the future. It was, we are doing this right now. We're seeing it in the numbers. And so you just see these themes start to really develop in front of the rest of the marketplace. And if you can get in front of the marketplace, embracing a theme, oh man, that's a good place to be as a bull.
Yeah, no, and another mega theme, like in the first quarter of 2023, once again, it was a little bit harder because there weren't the huge, banners, but it was oh wow, companies are actually not having that, an earnings recession. There's not catastrophe. And one might say, well, how big a deal is that? Well, except for the fact that coming into 2023, you had numerous high profile analysts talk incessantly about there's going to be an earnings recession. There's going to be an earnings recession. There's going to be an earnings recession. And then when the first quarter came out strong, I did bullish plays for, months and months following that, man. I was like, well, if it's not going to manifest itself, there's too much negativity. I came into 2023 as a bear. I had a really good year, Matt. And one of the reasons I had a really good year, coming in being dead wrong, was recognizing the things that developed in earnings season, right? And then you got little themes. A second type of theme can be little like, oh, airlines are doing really well, or this company is reversing. They became profitable, right? And when Uber turned profitable several quarters ago,
I remember when Tesla became profitable for the first time.
Go look at the chart of Uber today versus then. Go look at the chart of Tesla in these 9 months that followed their first profitability report.
Think about that trend we caught on ELF, the trend we caught on ASO.
ELF is a great example of, oh, wow, this company.
And Abercrombie, another earnings one we caught through, another trend we caught based on earnings was Abercrombie last year as well.
Yeah, I know. And so if you can identify, and it's great when you catch the big, massive, that's great, makes trading easy. But there's lots of little ones that can emerge that literally can give you trades for quarters. True. And like one day I'm going to be like, oh my gosh, crude oil's at $87. I don't know what to do with it here. And that's, but I'll be happy for the quarters where I felt very comfortable with it. Right. And earnings can help replenish that watch list, and sometimes provide some themes that you're like, oh wow, right? Just it's really important to watch that thematic development in earnings season.
Agreed. So let's understand kind of the landscape, Mark, as we're heading into the fourth quarter reporting season that kicks off this week. Number one thing to understand is from the end of a quarter to the beginning of the new quarter, and I'm talking the end of an earnings season to the next beginning of the next earnings season, you always have downgrades here, Mark. It happens all the time. It's very, very normal to see these estimates get downgraded post-earnings season in front of the next. In fact, the average decline is between 3 and 4% typically. Now, where is the decline in estimates as we head into the fourth quarter reporting season? It's currently at 6.8% for the S&P 500, which is by far a much higher percentage than what we've seen in a typical quarter from an earnings downgrade perspective. Does that give you any concern as we head into earnings season?
Yeah, a little bit in the sense that, like, if you were at the bottom of charts, it would not, because then I'd be like, oh, lots of rooms to beat.
The pullback's so important, Mark, is this right here.
Yeah, no, but it kind of like, you have to beat this number. Like, if you're a bull and don't want increased volatility, if we're talking in a couple months in a lack of a narrative market where the market is priced in so much Fed cutting, Fed easing, all of that, but then that number is not significantly better, market's not going up. It's not going up, right? Unless, literally they turn on the QE pump. And even then, how much of that's already been put in, right? Type thing. But you set the stage, right? Low expectations. This is what bulls do very well. Economy held up okay. I think the final Atlanta Fed GDP was 2.7%. Their guesstimate. They've been pretty good on their guesstimate. So the economy held up pretty decently, all right? Retail sales and out there in everything you get from Santa Claus, we're all right, right? So you should beat this number, right? Now, our company's managing their books where you beat it soundly. Well, that sets the stage, right? That sets the stage for, at a minimum, stability, and certainly on an individual basis, some potential bullish runs.
It reminds me a little bit of as we were coming into last year, the market had aggressively downgraded forward earnings. They had aggressively downgraded more than what the typical quarter was, as it was kind of matching the conversation in the market that the entire market was embracing an earnings recession. And that's why when I was like, I do not believe there's going to be an earnings recession last year in the prediction podcast, Mark was like, whoa, okay.
That was a big call.
Well, it's because I was looking at some of the blended growth numbers, but we'll get into blended growth here in a second. But I kind of feel like that's what's happening a little bit coming into this earnings season is there's a lot of talk on negative economics for 24. A little bit of rinse and repeat, not as aggressive as it was last year. Would you agree with that?
No.
The economic recession calls for this year are not as aggressive as the economic recession calls for last year.
Everybody that made the call last year doesn't want to make it again. Even if they believe it, they don't want to make it because that's,
but they're not making the recession call, but they're trying to make that argument through their earnings estimates, Mark.
Yeah.
So they're not making an argument that we're going to see a technical textbook recession, but there is an argument that is being made based on these projections in earnings that we will see a downward drift in earnings and we may see an earnings contraction. That's what you're seeing a little bit play out in these estimates. Is you're seeing a little bit more outlandish estimates to the downside circa last year. It is typical to see estimates go down going into earnings.
Yeah, this is just setting the stage to beat these numbers.
A little bit of a more, hey, let's lower the bar just a little bit more. Let's lower that bar.
There's no freaking bar with these numbers.
Walk over it. The guidance.
It's like walking over the carpet. There's no bar.
There's a very low bar.
It's there in the carpet. The lint bar in the carpet.
We still got a high bar technically. We're still
yes, that's a difference.
But the bar is set low from a fundamental perspective going into this.
Yes, it is. Gotta love bulls. They know how to cheat in advance. They just do. They just.
Are you kidding me? Bulls are the best cheaters in the market.
They are the best cheaters in the market. They're so good. And once again, if you cannot accept this fact,
it's just the truth of the market.
It's just reality.
Bulls cheat with the best of them. There's no doubt about that. From a guidance perspective, Mark, it's pretty typical to have more negative guidance than positive guidance, regardless of the quarter you're looking at. Right now, you have 111 companies providing forward-looking guidance in the S&P 500. Of those 111, 72 are reporting negative guidance, 39 are reporting positive guidance. That's slightly above the 5 and the 10-year average from a guidance perspective. I don't think there's a takeaway here from guidance as of yet. I think it's important to see where these numbers are as we start to get through earnings season. But as of right now, I wouldn't have a strong opinion one way or the other regarding the guidance of the S&P 500 as of right now. Now, one of the most important numbers that I track on a quarter-to-quarter basis in earnings is the blended growth rate. Now, the blended growth rate is a really important fundamental metric that I look at that takes into account both the actual results that have been reported by these companies in the S&P 500 in comparison to what the forward estimates were for those S&P 500 companies. And so right now we have relatively zero companies reporting in the S&P for the fourth quarter. It's more than zero, but you get my point. We're just kickstarting earnings season. So right now the blended growth for the S&P 500 mark is a rock solid 1.3%. 1.3%. Now, did I say rock solid 1.3%? Because estimates for the last 5 quarters have been negative on the blended growth rate. In fact, it was last quarter.
Oh, that's true. It has, hasn't it?
This is the first quarter we were projecting a positive. Remember, last quarter was a really, really good quarter, and we ended upwards around 8% last quarter, averaged out around 4.6% on blended growth last quarter. But we ended at right around 8% at the very, very end of earnings season. Remember, we've dealt with 6.7% downward estimates, remember? And so these downward estimates have brought that 8% growth down to around 1.3% on the blended growth rate because you take into account the estimates, right, versus the actual. Well, as these actual reports come in, typically speaking, you get about 72, 74, 75% EPS beats in the market. Well, if 70 to 75% of the S&P 500 is going to beat the estimate, you'll obviously see improving conditions through the blended growth throughout the quarter. This is a metric that I laser focus on in earnings season. Where last quarter we started out at negative 0.3. I said it's going to end in a positive. We were obviously right. You're going to say the same thing here. If earnings season is going to be a good season, it's not whether or not it ends with the blended growth of 1.3. That's where we're starting. We probably need to end in the 5 to 6 to 7% range for the market to continue to project or to continue to move in the same direction that the market has been going in. This is the first time we've seen a positive estimate going into the earnings season in the last 5 quarters. If we do go positive here, which again is the most likely scenario by far as we end the quarter positive, well, that will be the second consecutive quarter we actually have positive earnings growth out of the blended growth number. Now, that's what I track for the most part. A secondary number, revenue growth, is currently at 3.1%. I don't really track as often revenue growth as I do EPS growth. It's usually positive. It's been positive, I think, for like 22 consecutive quarters. It's obviously going to be positive here as well. Mark, a couple thoughts on the blended growth number, the importance of it, why you track it, or why you enjoy me tracking it.
No, because this is your baby. I wouldn't even know about it if it weren't for you, to be honest. I'm a thematic guy. I dive into other things. You're my earnings guy. I wouldn't even know about it. But it is a real number, right? And it reflects and gives you a sense of how companies truly are handling their business. And Matt, when I look at numbers like that, listen, I have started over the last 3-4 months giving companies the benefit of the doubt that, yes, tough macro environment in the sense you've raised interest rates so high. I've started giving companies the benefit of the doubt collectively that they know their business better than us analysts do. Yeah. And that as long as we see these numbers trend healthy, to give them the benefit of the doubt, right? To give them. Now, whether it'll be companies that don't do well, yeah, right. That's why we pay attention, right? But collectively, right, I think this number lets you know I look at it as the collective management number. Like, how is management of the biggest companies in the United States of America doing? And not too shabby, actually.
Well, and again, the general takeaway is we ended last quarter at 8%. You saw 6.7% downward drift in expectations. That brought the expectation of blended growth down to 1.3%. You track it throughout earnings season and these important weeks to see the improving or deterioration condition. so that you don't have to rely on some talking head telling you how the earnings forecasting is. Because again, just think about this from an accuracy perspective. The same forecasters are always wrong. That's why this blended growth will improve. And that's why the earnings revisions to the downside will be proven wrong throughout earnings season. And so instead of relying on the same forecasters who are always wrong in earnings forecasting, we just look at the actual numbers, the actual results, and we look at that from a blended growth perspective to see, are we really improving throughout earnings season based on expectation, or are we really deteriorating throughout earnings season? Relying on the numbers of earnings is always going to be far more important than listening to anybody's opinion on those same numbers. And so that's what we like to do at Tackle Trading. And very quickly, I say this all the time. I'll say it in the pod, I'll say it in the halftime report. Massive shout out to FactSet. FactSet does a wonderful, wonderful job of laying out the macro condition of earnings. I believe they put together a wonderful little write-up every single week. That's gospel for me every single week. I read their stuff all the time. I could not stay in tune with the macro conditions of the earnings conversation if it wasn't for FactSet. So massive shout out to FactSet. They do
it just 30 years ago, you and I could not exist. We would not have access to even nearly to the information. We couldn't compete. We couldn't, we just wouldn't have the same data. There has been a democratic type democratization of financial markets.
You've seen it in the markets, you've seen it in politics, you've seen it around the world. The internet has done that. The social media has done that. It's been fascinating.
Yeah, and it's like it's a different game. It's a different game, one that I very much enjoy.
I like not having to rely on Wall Street's opinions of things, because quite frankly, myself, like many, many, many Americans, do not trust Wall Street and do not trust their opinions. And by the way, Jamie Dimon is now going to be in charge of the ETF for Bitcoin. That is absolutely the most ridiculous.
I mean, it just like,
what are we doing?
Yeah, I mean, we could go off for a long time, but needless
I don't want to. It's just ridiculous.
They're a bunch of liars, charlatans that mix half truth with lies, and that's just the way it is.
That's just the way it is. But back to this conversation. So that's where we set from a growth. We're going to be tracking the 1.3% every single week. And Mark, every Monday on the halftime report, I do a macro earnings update. I don't do that in the podcast. I do an earnings update in the podcast as we go into earnings season. We'll obviously do an update in the podcast, but we'll primarily do that in the halftime report on each Monday. Now, a couple last points when it comes to earnings season and kind of where we sit from a landscape perspective. Valuation. The current forward PE ratio in the S&P 500 is 19.2. The 5-year average is 18.9. The 10-year average is 17.8. And so, like I was saying earlier in the podcast, one of the reasons I feel it was really important to alleviate the overextended condition going into earnings season is not only were you overextended, I do not believe technically you're overextended any longer, but not only were you overextended, you were also overvalued. Now, those two oftentimes go in conjunction with one another, but it's very, very, very close right now. Forward PE ratio at 19.2 is certainly putting the upper ends of that high valuation. You're slightly higher than the 5-year, a little bit high against the 10-year. Now, from a sector conversation, Mark, the highest sector going into earnings season from a forward PE ratio is the info tech space with a whopping 25.5. The lowest sector from a forward PE ratio is by far the energy space. One of the reasons I think we're all kind of geeking out on the opportunity in energy is not only is it coming from a lower point on the chart and starting to crude oil start to go through reversal, you also have a valuation argument that this is the lowest area of the market. The second lowest area of the market would be, off the top of my head, finance, right around a forward PE ratio of 14. And the second most highest overvalued area of the market from a PE ratio perspective is the consumer discretionary space. I think they're right now at around 24 on the forward PE ratio. So we're slightly overvaluated going into earnings season, Mark. And then last, certainly not least, are those components that are reporting this week. In the S&P, there are 9 companies reporting. In finance, you get the big dogs, JP Morgan. They kind of set it off. Bank of America, that's Tackle 25, Bank of America, Wells Fargo, BlackRock. Those are your 4 major financial companies that are reporting on Friday. In healthcare, you have United Health, the massive healthcare company, United Health. Out of United Health, you got consumer cyclical, KB Homes, you got Pepsi and Albertsons in consumer defensive, and rounding it up in industrials, you have Delta Airlines this week as well. So I hope that helped you understand the earnings landscape going into earnings season. We're going to be tracking these every week, every day in the halftime report on Tackle Trading's YouTube channel. So if you are not a subscriber to our YouTube channel, head over there to YouTube and make sure you hit that subscribe button for Tackle Trading as well.
Yeah, thank you for listening, everyone. We appreciate you very much. We look forward to, hopefully doing as good a job as navigating as we have over the last couple of years. I think we've done a stellar job. Market hasn't done much, but there's been a lot of back and forth. We've called some key inflection points. Go look at YouTube, Art of Reversal, to see Matt doing Art of Reversal in the October 2022 and July 2023 top. We'll help you. We'll help you.
Do that webinar every time I think there's an intermediate to major reversal in the markets.
Yeah, and I don't think it's here. I noticed there isn't an Art of the Reversal.
It'd be on our schedule if it was.
Yeah, listen, it's tough to break uptrends. I think the setup takes time, and I don't think that's yet. So I think bearish, you're gonna have to live with some bearish credit as if you try to go this hard directionally.
I think you got to see earnings season first, personally, but
yeah,
that's why we spent the entire pod talking about earnings. It's that important.
While we debate all that, I'm going to add some to oil this week. So, everyone have a fantastic week. We'll catch you next week with 561.
Later, everybody.